Hello everyone, this is Gary G. This is the enhanced parabolic SAR strategy as created by Charles Sarver. I wanted to record this video because in the previous Google Hangout video, Charles' voice is not clear, and plus I've tweaked the TOS setup to make it better. So what we have here, one difference that we have here is that in the previous TOS setup, Charles was using Heiken Ashen candles, and Heiken Ashen candles attempt to show you the trend in clearer detail than the actual candles themselves. So in this particular example here, these candles that are green would have actually been colored red because they're actually part of this downtrend. So Charles recommends, and I also recommend the same thing, not to use Heiken Ashen candles for trading Forex. I think he says that it works good for oil, but not for Forex. So I've changed these candles back to regular candles, and then what I've also done is I've changed the colors on the two moving averages. You've got the whole moving average. You have a faster one at 10 periods, and then you have a slower one at 25 periods. So what I've got is on the faster one, it's yellow if it's an uptrend and red if it's a downtrend. On the slower one, it's blue if it's an uptrend and magenta if it's a downtrend. And the way you read this is, the reason I changed these colors here is that you want to distinguish between the two, because on the faster moving average, when the yellow is above the blue line, that signifies an uptrend. And then when you have a crossover here and the purple line is above the red line, that signifies a downtrend. So what you're actually looking for in an uptrend or a downtrend is you'd like to see these two lines here be steep, and also you like to see some separation between these, or space between these lines, and same thing on a downtrend. Now what you also have here is you have the parabolic SAR, and when the dots are above the candles, that's signifying a put or a downtrend, and when the dots are below the candle, that's signifying an uptrend or a call. And then what you have here in the middle is you have the MACD, and when the green line is above the red line, that signifies a uptrend or a call, and when the red line is above the green line, that signifies a put or a downtrend. And you see this histogram here in the middle here, which actually mirrors the same thing as these lines here. When you see the green line crossing over the red line, you see that the histogram turns red. And here, when you see the green line crossing over the red line, you see the histogram turning green. So what happens is that you notice that there's lighter green and darker green. What it means when it's lighter green, it means that the volume is increasing, and same thing here with the lighter red and the darker red. The lighter red means that the volume is increasing. So anytime the volume is increasing, these lighter colors like lighter red or lighter green, that's good because it means that the trend is strengthening. Down here you have the momentum indicator, and what you're looking for is ideally on a call, you'd like to see this above zero and pointing up, although it doesn't always have to be above zero. And for a put, you'd like to see it pointing down and below zero. So above zero for a call and below zero for a put, but it doesn't necessarily always have to be that way. And then you'd like to see it be a smooth uptrend. You don't like to actually see this jagged up and down, because that would then mean that the price action would be choppy, which would be like red candle, green candle, red candle, green candle, red candle. You actually like to see it more smooth. So if we take a look at this thing here, following the rules here, what you're looking for, like on this downtrend here, you're looking for the magenta line for the slower moving average for the line to turn magenta. Looking for the faster moving average to turn red. So you want to see magenta on top, red on the bottom with some space. Then you're looking for the Parabolic SAR to be on top, looking for the MACD crossover here, and you're also looking for this to hopefully be down below zero and pointing down. So if we take a look here to see where all this stuff lines up here, let's see here. So the MACD is usually a slower indicator than the moving average. So if we take a look at the MACD here, the crossover occurred actually here, but you actually want to see some space in between the two MACD lines here. So you could actually, here's where it actually, there's some space between the lines here, and if you take a look up here, you have a red line here, you've got magenta line here, the Parabolic SAR is on top. But what happens is that you could actually take the trade here. The momentum is not below zero. It's really not declining. It's declining slightly, but you could take the trade here. And since this is a 5-minute chart here, you would actually do a 10 to 15-minute trade. So if you did a 10-minute trade, it'd be here you would have wanted. A 15-minute trade here you would have wanted. Or in this particular case here, if you really wanted this thing to be below zero, you could have taken it here, and you would have won it with a 10-minute trade or a 15-minute trade. Now if we look at an uptrend here, we have an uptrend here, and so you see the yellow line above the blue line signifying an uptrend. This is a steep, the slope on both these lines is steep. There's space in between them too. The Parabolic SAR is on the bottom. So as we mentioned before, the MACD is usually slow. So we take a look at here. Here's the crossover. Here's the first real green bar with some space. And you could have taken, the momentum is barely above the zero and it looks like it's flat. But you could have taken the trade here, a 10-minute trade or a 15-minute trade, and actually won that. And that's probably where I would have taken the trade. But you could have, if you wanted to be a stickler here, you could wait till this thing turns up, in which case it would probably be this candle here. Now nobody knows how long these uptrends are going to last, and using hindsight here you can see that this uptrend, it's still got a little bit more to go, but this is kind of like high up in the uptrend to actually be taking a trade. If you would have actually taken a 10-minute trade here or a 15-minute trade, you would have won either one of them. Or if you wanted to stack trades, some people like doing the same, putting in the same trade 3 or 4 times at the beginning. I don't actually like to do that. If I was going to stack a trade, it would either be on a longer term, like half-hour trade, and if the trade is going my directions, maybe after 5 minutes I'll put another trade in. Or in this particular case here, on these types of trades, if you wanted to stack the trades, you could do a 10-minute trade and a 15-minute trade. So it's up to you what you want to do, or you could just choose not to stack trades too. Because the goal is to win, if you remember my money management spreadsheet, is to win 4 trades per day without any losses. And so you want to be picky and you want to be conservative on the trades that you take. Now something else that I want to show you is that it's important that you look at the candles themselves to see what is actually happening before you actually take the trade, because you're actually trying to capture major uptrends and major downtrends. You really don't want to play stuff that's in between where it's going sideways, or it really is not a major trend. So here's an example here where the Parabolic SAR shows an uptrend. The yellow is above the blue, plenty of space in between. This looks like a pretty sharp slope, and so if we take a look at where we would have potentially taken this trade here, the MACD here, if you take a look at it, is actually signifying no trade here. Because if you take a look at these lines here, there's very little space between the red and the green line, even though it crossed over here. And you also want to see the red and green lines up sharply, like you see here for this uptrend here. Here they're almost flat. So if you were going to try to force this trade, maybe you would take it about here. You can barely see some space between these two. That would have been, or if you had taken it here. Either one, if you'd actually started looking at it here, and then, let me see here. It might even be here where the momentum was actually pointing up. But if you look at the price action of what's going on with the price here, you can see there was a big candle up and it's actually going sideways and down. So you shouldn't take the trade here. So then if you follow the price and see what happens, it dips down and you actually see the shorter whole moving average actually turn red. The longer one is still blue. So then you actually see the shorter one actually cross over the slower one, and then you see it cross back over right here. And then you see a nice slope on the yellow line. It's now above the blue line. So this here is actually a good entry point to take a trade. So if you had actually taken the, now I know that this thing down here is declining on the momentum thing. That's why, like I said, you don't always have to go with the momentum thing, but I would have actually taken this trade here because both of them are on an up, or are sloping up. This is coming back from a retracement, and the yellow line is above the blue line. And if you would have taken a 10-minute trade here, you would have won. A 15-minute trade here, you would have won also. So that's about it for this discussion of the strategy. The thing that you're trying to do is capture the major, get in on the major uptrends and downtrends. Of course, nobody knows how long an uptrend is going to last and how long a downtrend is going to last. There are fake outs that you can get into here that will cause you to lose, and so the thing to do, I think, to avoid fake outs is to actually look for these lines to be sharply up or sharply down. And the other thing about it too is that you want to look for a good entry point and look at what the candles are doing. Like if the price action is choppy, where you've got like green candle, red candle, green candle, red candle, I wouldn't take the trade. You're actually looking for something like a sea of green candles or a sea of red candles. And since you're actually looking for to get in on a major uptrend or downtrend, if it turns out that so what that means is that you don't necessarily have to get in where it signals the trade. You could actually watch the trend for a while, and if the trend ends before you can get in, well, you just look for the next one, especially on a long downtrend, because what you actually see sometimes on a long downtrend is you'll see retracements like this, where it goes up like 3-4 candles and then it goes back down, and then it's solid red candles after that. So what all these indicators and moving averages are trying to indicate or show you is that, hey, a downtrend is happening. But like I said, what you want to actually do is you want to pick and choose where in that downtrend, find a spot where it's going up and up and up without red candles, or it's going down, down, down without a lot of green candles or retracements in between. And that's what you're actually trying to do. And like I said, if the trend ends before you can get in, well, no big deal, just look at the next one. Now I've also seen here where this MACD here is actually pretty good unless there's a deep retracement, that on uptrends here you could have it go down 2-3 candles, but the MACD remains green down here, which will save you from a fake out. And the same thing that I've seen here on a downtrend that it could go 2-3 candles on a retracement and it still stays red, in which case you wouldn't take the trade. So anyway, that's it for now. And if you have any questions on this, you can just send me a message or post it in the group. Bye for now.